Want to know why your mortgage jumps? Why stocks suddenly freak out? Why safe portfolios still bleed? Stop staring at the stock market. Watch Treasuries. Because Treasuries are the price of money. And when the price of money moves fast, everything you pay for moves with it. Here's the twist. When investors panic, they run to safety. And that safety can still shake the whole system. By the end of this video, you'll read a yield headline and know what it's about to do to your payment before the anchors finish the sentence. Alright, let's kill the confusion first, fast and clean. A bond is an IOU. You lend money. You get interest. You get your principal back at the end. U.S. Treasury is that IOU, issued by the US government. And the labels matter. T-bills are short-term. T-notes are medium-term. T-bonds are long-term. Now here's where most people get lost. Bonds have two numbers that sound similar but behave like enemies: price and yield. They move in opposite directions. Always. More demand, the price goes up. But the coupon payment stays the same. So the yield goes down. Less demand, price down. Yield up? Think of it like this. The coupon is the rent check. The price is the building. Rent might be fixed, but the building's value can swing. If you remember one sentence from this video, make it this. Yields are gravity. Everything else is just jumping around inside the gravity field. Now, next question. Who decides the gravity? The government doesn't set long yields most of the time. The market does through auctions. Here's the simple version. The US needs funding, so it sells new treasuries on a schedule. Big buyers show up and bid banks, pensions, insurers, funds, foreign buyers. Strong demand means higher prices and lower yields. Weak demand means lower prices and higher yields. And people watch these auctions like a heart monitor. Not because it's fun, because it's system health. When auctions go smoothly, the system breathes. When demand stumbles, yields can jump. And that jump is like tightening a wrench on every borrower in the economy. Quick reality check. People say the Fed sets rates. True for the short end. But the 10-year? That's the crowd. Millions of decisions. One benchmark. Okay, so why are treasuries called risk-free if they can still cause chaos? Because risk-free is a specific claim. It's about default risk, not price risk. Treasuries can still drop in price. If yields rise after you buy, your bond price falls. And inflation can still eat your return. Getting paid back is nice, unless the money buys less. So why do treasuries sit at the center of finance anyway? Because treasuries are top-tier collateral, the cleanest reference asset. The baseline that everything else builds on. Think of treasuries not as a seatbelt, think of them as the floor. If the floor shifts, everything on top wobbles. Calling treasuries risk-free is like calling water harmless. Sure, until you're trying to breathe. Now let's connect this to your life, because that's the whole point. First, mortgages. 30-year mortgage rates don't come from magic. They're heavily anchored to longer-term yields, especially the 10-year plus a spread. So when the 10-year yield jumps, mortgage rates usually follow. Not instantly, not perfectly, but directionally, yes. That's why you can wake up, see 10 years spiked, and already know refinancing just got harder and buying just got pricier. Next, stocks. Stocks are basically future cash flows in a costume. Yields help decide the discount rate, how harshly we pull the future back into today. Higher yields mean future profits are worth less right now, especially for growth companies where most value lives far out in time. So the same earnings forecast can produce a totally different stock price depending on yields. And this is why stocks sometimes fall on good news. If good news pushes yields up, the discount rate can punch the market anyway. Now zoom out. Credit, corporate borrowing, and the job market. Companies borrow off benchmarks that ladder up from treasuries. If yields rise and spreads widen, borrowing costs jump. Then hiring slows. Projects get cancelled. Layoffs show up later, like thunder after lightning. So yes, treasuries can sound abstract, until you realize they're wired into the rate on your house, the valuation of your portfolio, and the cost of capital in the real economy. Now I want to make you operational like you're reading the system, not just the headline. When you see yields move, ask two questions. 1. Why are yields moving? 2. Which part of the curve is moving? If yields are rising because inflation expectations rise, the market is saying, money buys less. Pay me more. If yields are rising because real growth expectations rise, that can be good for some parts of the economy, but it still pressures long-duration assets through a higher discount rate. If yields are falling because fear is spiking, that's not always calm. That can be risk-off. Stocks can drop even as yields fall. Safety bids can be panic, not peace. Here's the cheat code most people miss. Don't just watch the number. Watch the speed. Slow moves are pricing. Fast moves are stress. A 5 basis point move is a breeze. A 50 basis point move is the system yelling, something's on fire. Quick recap in one breath. Treasuries are the baseline, yields are gravity, auctions are the heartbeat, and your mortgage rate is basically the echo. So when you hear treasuries are moving, don't treat it like finance trivia. Treat it like weather, because it is the weather system your money lives in. If you want, the next video is the yield curve. What it predicts, what it doesn't, and why people fear it for the wrong reasons. If this helped, hit like, subscribe, and drop a comment with one yield headline you've seen recently. I'll translate what it actually means in plain English.